Did the SP500 ever outperform the Nasdaq 100? It seems like no matter how many times I backtest SPY versus QQQ, QQQ always outperformed SPY except around 2000, 2003. Yet people on Reddit generally like to recommend SPY because it's more diversified, but QQQ has outperformed by almost 5 every year since 2003. It all has to do with your age and your goals. QQQ is great for young people with long time horizons who can hold through the dips that come. Someone near retirement can't risk suffering the losses that QQQ saw last year. You say in a comment it's up 36, and while that's true, it was down 33 last year and still isn't back to peak. I'm 30 and hold a good chunk of QQQ and have no problem with it, but again, imagine having QQQ as your biggest holding and it drops 33 last year and you're retired and need money. That is a harsh way to start retirement. So really the best answer is, it depends. As with anything, build a portfolio to your personal goals and risk tolerance. When QQQ gets hit, it gets hit hard. When times are good, it flies high. Since it is so concentrated on technology, I personally don't like having all my eggs in one basket, so I go 50-50 VU and QQQ. Still a really high concentration of tech, even with VU, but it works for me. Pretty sure Nasdaq crashed harder than SP in 2000, 2001, when the tech bubble burst. I would say Nasdaq is generally more aggressive, but a bit less safe, because of the nature of the companies involved. And the fact it's less diversified. I own some QQQ, but I also own some SP funds. Have a mix. But it also bleed more during downtimes versus SP500. Can you take it? The last time this happened was last year. Higher returns is not the expected outcome of a more diversified portfolio. A more diversified portfolio protects against the idiosyncratic risks associated with a less diversified one. QQQ Apple protects against the volatility of one company's stock performance, and protects against the collapse of this one company. SPY QQQ protects against tech bubble crash, top holdings over concentration in tech notwithstanding. VT SPY protects against US market decline crash. 60/40 equity bonds 100 VT SPY protects against equity market crash. The SP500 has existed in its current form for 65 years and can be calculated back decades further than that, so it has a very rich set of statistics. This is preferred for the timescales at which most people are investing. If I'm 30 years from retirement and 60 years from death, 25 years of history isn't enough for me. I'll take the reduced risk from a more diversified index, even if it means reduced returns. Part of the problem with the sub is general advice they echo without explaining. There's a reason people who give advice have 100 pages of disclosures while the just buy the SP crowd throws that out willy-nilly. There are several ETFs that historically beat the SP always, like QQQ. One issue is keeping your money in those ETFs when they're down 30 and not panic. People are very emotionally attached to their money. I don't have the numbers, but SPY outperformed QQQ in 2022 by losing less that year. It took Nasdaq years from the dot-com bubble to make another all-time high, I think like 2015, so if you do analysis starting before dot-com bubble, your results will be different. For the record, as long as money is expensive, tech is going to get dragged like we haven't seen in 20 years. Tech requires lots of cheap speculative money. Interest being high and likely remaining high will hurt tech earnings, and not just short term. I'm finding the conversations in this thread interesting. Especially the strong contingent of people that are in the diversification is overrated group, as well as the past performance does predict future results group. I wonder if that all says something about the market we're in, with conventional wisdom going out of the window for a lot of people. It really all comes down to risk tolerance and how big long of a setback you're able to take at this point in your journey. I do mostly VU but add individual QQQ constituents to weight. This way I can maximize exposure to what I think are long-term winners: Google, MSFT, Amazon, Apple, but avoid things like Nvidia and Tesla. I also think a few of the QQQ constituents are kind of weird to be tech, like Pepsi. I'm in your boat top. I started out classic bogle with 80 VTI, 15 VCHS, 5 BND. Now I do 45 VTI, 45 QQQM and 10 SCHD. I started loading QQQM about a month before the nadir, and it has been a tremendous boost to my portfolio during this recovery period. I fully expect increased volatility compared to the prior portfolio, but I have about 20-30 years to retirement, so that's fine by me. What's the variance of QQQ compared to SPY? Higher risk, higher reward. QQQ has larger max drawdown compared to SPY, for example. QQQ is 50 tech versus SPY 25. Concentration risk. .com's fall for tech stocks is too nasty. SPY, generally speaking, don't drop more than 50 even during 08 or 0002. Tech went to like 25 of the 80H for a long time. I bet you can find a specific period. Try ending it right after 2000. When I run 1999, 2023, QQQ only has a 0.12 advantage on CAGR 6.57 versus 6.45, but the standard deviation is 23.5 versus 15.4. Max drawdown is 81 versus 51. So if you were transitioning from accumulation to retirement in there, you are at much higher sequence of returns risk. Like most investing, it's about more than just straight return. Lol, what about 2022? If you really want to get radical, then go TQQQ. I've been thinking the same thing lately. I like that QQQ has a good option chain like SPY. I'm thinking on the next big dip I'm loading the boat on QQQ. I really don't understand the need to diversify away from technology, which literally is the one thing moving human civilization forward. I'm all QQQM and I'm not looking back. I just think it's very odd to keep such loyalty over a stock exchange. What stops future tech companies from being listed on the NYSE? Might as well buy a big tech ETF. In any downturn, the SP500 likely outperforms during those short periods. Yes, during all down years. Wait till you find out about TQQQ, romantic face, romantic face, romantic face. Tech companies survive and thrive when money is cheap. They typically don't have cash flows to sustain their business, and they are often in growth mode, reinvesting what little income they have. Cheap cash is the lifeblood of tech companies. For the last 20 years or so, interest rates really only went down. In the past year they went from basically 0 to 5. I would not expect the next decade to look like the last one. What's the volatility of those two indexes? Okay, if you still are on the fence about this, then allocate your portion between the two. Then in 10, 20 or 30 years, you'll be half right or half won't. No biggie. Will TSLA, BTC etc. outperform the market over the same years? We're all looking for the safest investment with the highest ROI. One bad move will skew your future performance. And believe me, I already had plenty. Yes, it did. We're in a tech-heavy era. Nasdaq is tech-heavy. It did in 2022. To those saying buy the entire market VTI and not just a subset QQQ, shouldn't you all be recommending to buy VT? Because with the SP500 or entire US market, you're also just buying a subset. Why does it matter which exchange the company is listed on? If you want to overweight tech, buy VGT, VUG, SCHG etc. on top of SP500. Over the short term, $SPX has outperformed $NDX. As you said, if you pick certain 1, 2, 3 year periods, you can find outperformance. I seriously doubt there is any 5-year period going back to 1990 where $NDX outperformed $SPX. Sure, in the first half of 2022 the SPY outperformed QQQ.